When the Fed decided its next move was to do nothing, that left investors with a problem they've had for about 8 years: how to get income in a dirt-low income world. I'm Jack Otter, editor of BARRON'S.com. I'm here with Priscilla Hancock, who is the global fixed income strategist at JPMorgan. So let's start off with your kind of big picture view of where the Fed's non-move leaves us in looking at fixed income.
Well, it's a good question. I think it's been a lot of scratching of the heads. If you think about the reason the Fed would typically tighten, it's because growth and or inflation are getting out of control in the United States. Clearly, we don't have either of those situations. What they do have now is a situation where they're trying to figure out when they can actually just remove the extraordinary accommodation that they've been putting in. And the U.S. numbers alone would suggest that we should do that. What they told us last week was, well, the U.S. numbers may look like they're okay, but we're looking at the fact that we've had a strengthening dollar, we have weak commodity prices, and there's a slowdown happening in the emerging markets, and we're not quite sure how dramatic that slowdown is. And because we're concerned about that, we're going to be cautious.
And if you look back in history, there have been times when everything looked okay here, but there were global problems that did reverberate back to this country.
That's exactly right. If you look at the late 90s, for instance, you had a similar situation, and the Fed tightened in the face of that. In those times, the big emerging market partner was Mexico, put too much pressure on them. You know, a strong dollar and higher rates here increases the cost of borrowing for emerging markets, so it created a crisis. And I think the Fed's concerned about that. They've looked around the world since the crisis. We've had 12 central banks that have tightened. All 12 have since eased. So you really almost can't be too cautious here.
So into this world, where should investors be putting their money?
Well, if you think about that, that probably means that there's an opportunity for duration, buying longer bonds, because long-term rates are going to stay low, and they possibly will stay low even once the Fed raises rates. But I think you have to be looking at some of the risk sectors today, and you recognize that in the United States, the economy is doing pretty well. So corporate credit has a very attractive top line. Defaults are very low, particularly in the high-yield sector, and you're getting paid a pretty attractive coupon there. In fact, spreads have increased 175 basis points since a year ago. You can get over 5% spread in the U.S. high-yield market, ignoring energy and metals and mining.
And when you say spread, you're referring to the distance between what that bond is paying and an equivalent treasury bond.
An equivalent treasury bond, which is about a 4 to 4.5 year treasury bond. That's about the average duration of the high yield market.
But you're making a distinction between high yield and then just standard corporate credit, which you say is exposed to some other things that might be a little dangerous.
Well, that's exactly right. I mean, you're seeing corporate credit strength across the board, but when you look at the investment grade sectors, though those credits that are rated BBB or higher, many U.S. markets have global exposure. Think of Procter & Gamble, for instance, and I'm not using them only for illustrative purposes, but if you think about it, they have a lot of global demand. And the bottom line is if the global markets are slowing, that could put some pressure on them. The other thing about the investment grade sector we're seeing is that, you know, money's cheap. And with cheap money, the question is, do they start borrowing too much? Do they increase their leverage? Does it get them into trouble? Not in the next 3 to 6 months, but over the longer term.
One more area of interest, particularly to people with higher incomes in taxable accounts, municipal bonds, and you think there is some value there?
Yes, I mean, they're cheap to taxable bonds, and what I mean by that is you can get rates in some parts of the curve that are the same as taxable rates, and it's tax-free. So if you're in a higher tax bracket, municipals are very attractive. And the other thing about municipals is that when rates do move up, if they move up, they typically outperform. In other words, they don't lose as much value as comparable taxable bonds. A couple sectors you have to be careful of in the municipal market. Higher education is one of them. That probably surprises people. If you think about, not the Harvards of the world, but you think about the changes that are happening in the educational system, a lot of people going to community college, that's going to put pressure on sort of that middle and lower tier of small liberal arts colleges. They just don't have the number of people that can pay those high tuitions. So we're cautious about that sector.
Great insights. Thanks very much, Priscilla.
My pleasure. Thank you.